Okay, so the concept statements again set out a broad set of standards by which reporting should be done. Now, one of the most basic concepts of financial reporting is that the financial statement should fairly present the financial position and the results of operations. Financial position, of course, being the balance sheet, the results of operations, the income statement. And so, at its core, the concepts say that's what you have to achieve. And if some accounting standard causes you to misrepresent something, you should ignore that accounting standard. Now, that doesn't happen very often in truth, but that's the truth about financial reporting, that our broad objective is to fairly present the situation as it exists. So the financial position or the balance sheet and the results of operations, the income statement, at the time that the financial statements are issued. Now, that would be a very principles-based set of standards if we just said that and ended there and let people make all their judgments based on that. But that would lead to a lot of inconsistency and a lot of questionable judgments. Now, concept statements are set out. The last one issued, number 8, discusses the objective of financial reporting and the qualitative characteristics of useful financial information. Number 7 described how cash flows and present values are used when making accounting measurements. Number 6 defines the accounts and, whoops, went too far there. Accrual accounting concepts that appear in the financial statements. Number 5 discusses recognition and measurement concepts. Now, all of the ones before 5, 1 through 4, have either been superseded or involve non-business organizations, and so they aren't part of what we're looking at in this book. Now, when we set out the concept statements, right here is an important chart, and it kind of shows you what the concept statements are all about. And these qualitative characteristics that we talked about with SFAC number 8, it was not the first standard or the first concept statement to deal with these, but it did supersede the others that discussed it before. But qualitative characteristics. Now, up here, the overriding objective is to provide financial information that is useful to capital providers. Now, how do we do that? Well, here are the elements of the financial statements that we use. So assets, liabilities, equity, investment by owners, that's contributed capital, distributions to owners, that's dividends, revenues, expenses, gains, losses, comprehensive income. Now, what are the qualitative characteristics of information that make it useful? Well, there are 2 overriding or fundamental qualitative characteristics. One is relevance. The other is faithful representation. Now, we've talked about both of those throughout the semester. So, what are the characteristics of information that make it relevant? Well, what is relevant information? Relevant information is information that pertains to the decision to be made, that gives you some insight into what the better decision would be. Now, what gives information relevance? Well, either predictive value, a value or an ability to help predict what's going to happen in the future. Confirmatory value, and that confirms or lets you find out you were wrong about previous predictions. So the confirmatory value, and to a large degree, confirmatory value is only useful in that it helps you evaluate your model for predicting the future. And then finally, materiality. Something is relevant if it's material. If it is materiality, just means it can make a difference in a decision. So we tend to think of materiality as meaning the big stuff, or sometimes you hear materiality as treat what's important as though it's important. But how do you decide if it's important? Well, if it has the potential to impact a decision. So that's an important part of relevance. And then faithful representation means that something is what it says it is. The old statement was it reports what it purports to report. It reports what it purports to report. In other words, it is what it sounds like it is. Cash is cash. Accounts receivable are accounts receivable. Property, plant, and equipment are property, plant, and equipment. So that's faithful representation. Now, what are the characteristics of information that give it faithful representation? Well, number one, completeness, that it's not lacking any significant detail. Neutrality, that it's free from bias is what neutrality means, and that it's free from error. So we want to make sure that information is complete, it's neutral, in other words, it's free from bias, and that it's free from error. Now, enhancing characteristics are comparability. Now, they used to break out comparability and consistency into separate enhancing characteristics. They have been lumped together in SFAC 8, But comparability is comparing one company to another. Consistency is the same company from one year to the next. So something that enhances the qualitative value of information if it is comparable and consistent. Then verifiable means two or more people working independently would come to the same conclusion. So historical cost is often referred to as it's highly verifiable. Two or more people working independently applying the same rules would come to the same value for historical cost. Timeliness means it's provided before it's needed for the decision. And understandability means it's presented in a way that the user can understand. Now, that assumes a relatively informed user. In other words, somebody that understands financial statements. Now, constraints, you only see one here. Usually we talk about two constraints, but the constraint here is cost effectiveness. In other words, the cost of providing financial information should be less than the benefit that's derived from using it. And so financial reporting is always subject to cost-benefit analysis or cost effectiveness. But that's what cost effectiveness is, cost-benefit. The benefit should exceed the cost. Now that one actually gets kind of complicated because you get one group that's incurring the cost and a different group that's enjoying the benefits. So we have a company that's incurring the cost of providing financial statements, and then investors and creditors who are getting the benefits. So the cost-benefit issue is sometimes a tricky issue. Now the other constraint is just human error, and that's a constraint on financial reporting as well, that it sometimes is bogged up by human error. Now, here are the financial statements, the balance sheet, the income statement, the statement of comprehensive income, and we've talked about that. You'll get into it more in Intermediate 2. But remember, we talked about in available for sale securities, debt securities, that gains or losses go to other comprehensive income and then accumulated other comprehensive income rather than to the income statement. Statement of cash flows, and then the statement of shareholders' equity. Now, again, the actual requirement is statement of retained earnings, but usually what's provided is a broader statement of shareholders' equity. Instead of just reconciling beginning and ending balance of retained earnings, we usually provide a statement of stockholders' equity that reconciles a beginning and ending balance of all stockholders' equity accounts. And then, of course, the related disclosures. Okay, then we get to the recognition, measurement, and disclosure concepts. And so there are 4 underlying assumptions. The economic entities assumption, which basically assumes that the business is separate from its owners and each business is separate. So we can take a conglomerate of many businesses and provide independent financial statements for each one of those businesses under the economic entity concept. And then we can say, okay, we can also consolidate them and show one set of financial statements for the entire organization as a different economic entity. But economic entity concept comes into play in a lot of places. Going concern just assumes that a business will continue into the indefinite future. So sometimes we get into a situation where the going concern assumption is questionable, where a business is in financial distress. And so that leads to some different financial reporting. If a business is in financial distress and we do not think they're going to continue into the indefinite future, then you may have to value assets instead of based on cost at liquidation value. What could you get for them if you had to sell them quickly? Periodicity is the concept of the accounting period, that we can nicely break the life of the business into months, quarters, years, whatever periods we want to do financial reporting on. Now, the SEC requires its registrants to do quarterly and annual reporting. Most businesses actually do monthly financial reporting. Okay, the monetary unit in the U.S., that's the dollar. We assume a stable dollar. We don't account for inflation, and we account for everything based on dollars and cents. Okay, then there are these 4 principles. We talked about the revenue recognition principle at length. We've talked about the expense recognition principle at length. We talked about the mixed attribute model, especially when determining fair value. And then we've talked about full disclosure at length. So those are the objectives, the qualitative characteristics, the elements, the assumptions and principles, the financial statements, the constraints dealing with financial reporting. Now, largely, the rest of the chapter then goes in and provides much greater detail about those various items. And I'm not sure, there's my cursor. Okay, so they talk about decision usefulness, relevance, and faithful representation. They get here and break those down into these different levels that we've already looked at. I really don't see that I can add a lot to what I've already said, but you need to go through and look at these. Make sure you understand each one in detail. So, and remember, the fundamental characteristics are relevance and faithful representation. Okay, the others then are under them. And here we get into the discussion about conservatism, and my time's just about up, so I'll begin the next video with a discussion of conservatism.